until we are connected. So done redirecting, and I think we should be live now, hopefully. Let's see. Let me just check. Yeah, looks good. And then got it. It's live streamed. And then I have to find my way back to the myriad of windows that are open. And let's kick it off. Hi, Jeevan. It's really great. Jeevan, what is the correct spelling of your name? I'm Austrian and I'm not very much used to British names still.
No worries. Jeevan.
Jeevan. Where is the name coming from? Is it a typically English name?
No, not at all. So my heritage is Punjabi. So Punjab is a small state in the north of India. So on both of my parents' side, my heritage is Punjabi. So it's a traditional Punjabi name. It means life. And my full name, Sukh Jeevan, actually means happy life.
That's a great name. That's fantastic. Happy life.
Thank you.
I like it. And it really spells well. I was worried at the beginning when we got in touch. I thought, how should I spell your name? I just know the Austrian versions, and it's great to hear that the correct meaning is happy life.
I quite like it. I think it's quite nice.
You're in England currently? How is life in England these days?
Very cold. So I'm just looking out my window right now, and it's snowing. We have about 4 inches of snow. But otherwise it's great. We can't complain. We had a lovely summer, so now I suppose we're just paying that back.
I'm curious to hear. I mean, it's the time of the year here in Austria when everybody and families are preparing for Christmas Eve in a week. How does that affect the life in England? Is it also a big thing in your environment?
Absolutely. So at Playfair, we're shutting down the office for a couple of weeks over Christmas, just to give everyone the time to shut down, switch off, really relax and get that full break before we come back in January and go again. So I think a lot of people are doing the same. Some of our startups are also doing the same thing as well. And I think it's just a really nice chance for everyone to get to spend a bit of time with family. Of course, London is a very diverse city. So a lot of people living in London either are from around the UK, whether that's Cambridgeshire, which is where I'm based right now, or whether that's the north, or even whether that's abroad. So I think it's quite a nice chance to give people the time to go back, spend a bit of time with their family, with their friends, relax for the period before coming back in January afresh.
Yeah, absolutely. I think it's necessary to get 2 weeks off to meet family and friends and also enjoy the other parts of life except work life. But let's make this podcast about work life, the final thing before Christmas. You mentioned your fund, Playfair Capital, and I'm really happy that you are here today to share your stories. I'm coming from the founder side. So I started my first attempt in entrepreneurship back in the 90s, was then in merger acquisition, then later on got in life science in 2006 in mostly startup companies, so translating science into business. And usually when founders take their pitch deck and send it to a VC, everything that happens behind the scene is pretty much a black box. And it's really great that you are happy today here to share your stories about what's going on in the VC life. And my first question to you is, what does it take to become a VC? What motivated you to go into this direction?
Yeah, that's a great question. I think, like a lot of people, it's super cliched, but I definitely fell into VC. It wasn't something that at the age of 15, I sat there and I thought my life ambition is to be a VC. So very much fell into it. I think for me, it was I was very much influenced by my family, who are very entrepreneurial. So growing up, my parents had brick and mortar businesses across retail or food and beverage or health and medical. And from the age of 8, I remember going around and spending time with them and getting to meet people that they worked with and getting to meet customers. And I'm sure an element of it was cheap labor, of course, on my parents' behalf, but they really encouraged me to think about, they used to ask my opinion. So when they'd say, oh, we're thinking of trying this out, or we're thinking of optimizing this, what do you think? And they really used to encourage me to have an opinion and to get involved. And I really love that. And I think firsthand, I saw watching them and their journey, just how passionate and really obsessive people can get about the things that they're building. They become almost like their babies, their children, like family members. And so I've always been around people, I suppose, through my family who have felt that way and who have, I suppose, had the self-belief and self-belief, but also at times delusion, to believe that they are the ones who are going to change something for the better. And they're not going to wait around for someone else to make that change happen, but they're going to make it happen themselves. And they believe in themselves and they back themselves to go and make that happen. I found that very inspirational growing up. And I suppose a lot of the founders that I work with nowadays are very much like that. They're people who are obsessed, passionate, want to make a change, want to make a real life impact in the world. And they want to go make it themselves, and they want to go do it yesterday. They don't want to wait around. And I find that energy just so inspiring. And I love being around that, and I absorb that, and it's infectious. And I think it's just it's a great environment to be around.
Absolutely, I couldn't agree more. What was your career path then? You got your first imprint by your parents, and what came next?
Yeah, so got that imprint, but still very much didn't know what I wanted to do. So I thought, let me just do something that I'm good at. I always enjoyed sciences. I was always a bit of a nerd when it came to the sciences. So I decided to go and study pharmacology at UCL. Spent a lot of time in and out of labs and both healthcare and also clinical settings in pharma as well. And I really loved the idea of being on the cutting edge of research. I like the idea of being involved in the uncovering of a new drug for a disease type that has impacted and hurt and caused pain to hundreds, thousands, millions of people globally. So I love the idea of that. I love the idea of the innovation that was happening in pharmacology. I especially loved psychopharmacology. So anything to do with, I suppose, the central nervous system, and particularly neurodegenerative diseases as well, I found very interesting. The reality of it for me didn't quite match the theory. So the reality was, and this is very personal to me, was spending a lot of time in the lab. It was quite insular. It was very focused around one particular subject. And I didn't always feel like it was super commercial. So things worked in the lab, and I struggled to see how that would scale and impact real lives and the real world. And I suppose through that, over a number of years, I became somewhat disillusioned as a process. And even though I still love health tech, I do a huge amount of look into a lot of our health tech deal flow at Playfair. So it's still an area that I'm really interested in, but it's just not the area for me to spend the rest of my career personally.
Yeah, I think it's sorry to interrupt you, but I think it's the usual ratio. So I wrote it down a couple of years ago that basically I think 99.9% of lab ideas don't translate into products later on. It's just the nature, I think, of science to have a lot of ideas, to publish a lot of or produce a lot of new know-how. Not necessarily everything must be a product at the end of the day. So it's a really fine line between it's a small percentage of the ideas in the lab that translates into later in products. What excites you the most in tech currently?
That's a great question. I think we're going through a massive change in VC, but also with all these macroeconomic factors around us, with all the change that's happening with the war, and obviously off the back of the pandemic. I think there are a lot of really exciting trends coming off the back of that. I personally spend a lot of my time looking at, as I said, health tech, construction, materials, So for me, I'm personally very interested in mental health and understanding how, at a time where there is a shortage of therapists, and off the back of a pandemic, which we know has caused increased levels of mental health issues in people, I'm really interested to see how technology can improve that. I'm really interested to spend a bit more time understanding how we can make materials more sustainable and how we can deal with shortages of materials. So again, during the pandemic, but even off the back of the pandemic, there was a real shortage of some of the things that we had very much taken for granted in construction or in roads and mobility, and understanding how we can become more self-sufficient, but also in a sustainable way. I think that's super interesting as well. And then I suppose, generally we look at, we're super early stage, right? So we're pre-seed and seed. And so I always say that we see things almost before the public even hear about them. We're almost 3, 4, 5 years ahead of the trends. And our founders are 2, 3, 4 years ahead of us in that sense, which is really cool. And so a lot of the stuff that we're seeing right now are generative AI in the use of gaming, or we see it a lot in relation to Web3, for example. So I'm quite interested to see how that plays out. Quantum computing, of course, and just the way supercomputers are going and the applications of that and how that will change the way that we live and work. I think that's super interesting. And I suppose there's a lot of volatility still in the blockchain crypto space. So still don't know which way that's going to go. It's very much on the fence, and very curious to see where that lands in the next year or so, and just to continue following that market as well.
You're pretty deep into investing here. You have a lot of ideas and see a lot of things. I mean, the blockchain, there were some unlucky events lately. So let's see where that goes. Let's talk about the socio-political topics first. In my environment, I get a lot of articles on my table about tech venture capital, and that there are not many women in that area. Not very many. So it's basically, from what I read on the internet, a male-dominated environment. And I would like to ask you the question: is it really that way? But what is the reality in your environment? Should there be more women in tech?
Short answer is yes, very much so. There's been lots of data and reports on this. I think Sifted did an article earlier this year. I don't remember the exact number, but I think the number was in the tens of how many women we have in decision-making abilities in VC. That's a massive issue. If women don't have a voice at IC level, at partner level, those unconscious biases that we always talk about in relation to female founders become amplified in my view. And it's not just in relation to female founders, but more generally, different people from different backgrounds, different genders bring a different viewpoint. And around a table, around an IC, you want as diverse a viewpoint as possible, so that you've considered every option, you've explored things that maybe your colleagues have missed, and to not have women equally represented when women form half of the world's population, you're missing a lot of viewpoints. You're missing a voice at the table. You're missing opinions that could be valuable, and not just in relation to topics that relate to women, but everything. Because, as I said, if women form half of the world's population, then most things that impact men will also impact women as well. So I think it's a massive issue. I think it's a massive issue in VC. Of course, it's a massive issue on the founder side as well. And it's very well reported that 1 to 3%, depending on the report you read, generally goes to all female founder teams. So that, of course, is a massive issue as well. But actually, even if you go all the way back on the LP side as well, you see that same gender divide as well. So there is a disproportionate number of men in decision-making roles on the LP side. And so suddenly you see this chain where that starts at the LP level, that flows down to the VC level, that flows down to the founder level. And across that chain, you can see that there is a real lack of female representation. And in my view, that's a problem that we have to look inward, and we have to think as an industry about how we're going to solve that. How are we going to attract more women? How are we going to nurture more women in this ecosystem? How are we going to bring them up so we don't just have women joining and then leaving after a couple of years? How do we retain them? How do we how do we do that across the entire chain? I think that's a real conversation that we should be having as an industry, because it's a failing on our part, in my view.
I mean, I'm happy that the society evolved since 1900, so we have a lot of more opportunities these days than my grandparents back then. What are the reasons, in your opinion, why there is a lack of women in VCs? What is the main problem? Why did that happen?
I think there's a number of reasons. Firstly, at the source of it, there are proportionally less female as STEM graduates. So less women are choosing science, technology, engineering, and mathematics as a future career path. And so if the majority of VCs come from that background, well, actually, you're not having women typically come and study and move up and even see VC as a career route. So that's the first thing. I think the second thing is it's a somewhat cultural thing. If VC is seen from the outside to be a bit of a boys' club and it's seen to be very male dominated, actually just attracting people who look different, sound different, might be difficult. It might be off-putting to people who actually want to be in a place where they can see people who look like them and talk like them. I think the third thing also linked with that is the lack of senior women in VC means less mentorship from people, again, who look like you and talk like you. People who can advocate for you, champion you, and give that advice and give that support in a way that maybe other people might not quite understand because they've not had the same experiences as you. I think those are kind of in my view, the key three things. But to be honest, I'm already in the industry, so I suppose what I'd love to hear from are people who aren't, people who are either aspiring VCs or people who have never considered VC as a career route, and I'd love to understand from them why not. Why is it that what are the barriers to getting into the industry? What are they struggling with? And I think actually that's how we start. We start by looking outward and saying, what's going wrong here. Otherwise, we I think are at risk of having almost a positive reinforcement by asking the people who have already drunk the Kool-Aid and who are already luckily doing what they want to be doing.
Let's assume a ferry crosses your way and gives you the ability to change one thing to attract more women or to have more women in the venture world. What would this one thing be that you choose?
That is a really good question. It's also, the problem is it's a cycle, because the more women you have in the industry, I feel like the more women you would naturally attract in the industry. And it's a bit of a cop-out to say to have more women. So yeah, it's a bit of a cop-out to say have more women in the industry. If there's one thing that I'd change, it'd be on the LP level. It would be LPs making real active decisions about the team composition in the VCs that they are backing. It's LPs saying, it's not okay for you to not have a woman in a decision-making role in your team, and we don't think that is a sensible business decision, and therefore we can't back that. And if the people holding the ultimate power were really putting their foot down and standing strong against that, I feel like that would have a trickle-down effect on a lot of VCs who then have to some extent, enforce some of that in order to be able to go out and fundraise, raise their funds, and be able to get LPs on side. So that's probably the one thing that I'd change if I could.
I think it's a great idea. I was just thinking about risk taking. I think having a balanced team of men and women in a fund makes absolutely sense in terms of risk. I believe men usually tend to make too risky bets. And I think it's just statistics. Right? The statistics I read say that when it comes to investing, basically on the long run, women are better than men. So it's less risk in the funds then.
I have seen that. I've not dug into the data around that,
Yeah.
but I've seen the headline and I'm happy to go with that.
I know it from my life. So it's sometimes it's good to speak with women to get talked out of the stupid decisions. So it's men like taking risk. Let's jump to the topic of the podcast. What happens behind the scenes when a founder pushes the button and sends the pitch deck to a VC? I mean, when we look at when we give it a narcissistic angle, I think the founder then thinks, I sent now the pitch deck, and the team at the venture fund sits there doing nothing, waiting for the one pitch deck arrive, and then they get the pitch deck and they happily contact the founder because they didn't have anything to do. What's the reality of a VC? How does the normal day look like?
So the reality, starting with the pitch deck coming in, is firstly, where does the pitch deck come from? Unfortunately, so we know that in VC we have a problem around warm referrals and warm intros through networks, which can often mean that if you are someone who is in that network, it can be easier statistically to get in front of a VC than someone who isn't. So I suppose the first thing as a founder to think about is, how are you reaching out to the VC? Is it a cold outreach on LinkedIn? Is it a generic message, or is it actually something that you've really thought about how you're going to come across to them? Whether that's sending a really personalized message on social media, whether that's trying to find a connection through mutual friends, whether that's trying to go places that you know that the VC is going to be, whether it's an event or a panel session. Whether that's taking part in a pitching event that you know that the VC is going to be part of the panel of that pitching event. It really differs in terms of where that interaction happens, unfortunately. So I mean, at Playfair, we've actually really tried to address that and change that. So we have a open type form on our website. Any founder from anywhere can come and upload their deck on our website, and two members of our team to ensure that we have some objectivity baked into the decision making. Two members of the team will go through the pitch deck and decide whether we're going to follow up with the founder. And the purpose of that is to really get around this issue of selection bias if that introduction or that pitch deck comes from one single source. So yeah, at Playfair, we're trying to change that. But yeah, unfortunately, that's generally what happens. And then I suppose it's just a case of whether the investor, in the 15 slides that they have in front of them, can see enough to decide whether to take a call. And really, that is the aim of a pitch deck. It's not to convince, it's not to showcase your entire business in 15 slides. The purpose and the aim of a pitch deck is simply to get that first call with the VC, and it's to give them enough information to go on to get that first call. There's loads of articles, blogs, resources online about how to create the perfect pitch deck, so I won't go into that today.
There are two questions that I would like to ask you now. I mean, you answered the second already, that we don't go into how to structure a pitch deck. I have also a video on my YouTube channel with a woman who consults startups up to IPO level, how to structure that. So there's enough information on that. But the second question that I would like to ask you is a debate that I'm having now for 16 years. And there are always these two opinions on the market. So one says founders should start building relationships to VCs before they need the money. So they should invest their time, go to events, get to know the VCs, understand the story. And the other school of thought is don't do that. Just approach VCs when you need money. When you need the capital. What's your opinion on that? What is the best way for founders to get in touch with VCs? Should they wait until they really need capital, until they have an investment case, or should they start earlier, or anything in between?
Yeah, the age-old question.
What was first, chicken or egg?
So what do I recommend my founders do when I'm working with them on a fundraise is to start making soft connections and at least start having calls with investors 12 to 18 months out of the fundraise in order to start building a warm pipeline of investors that you can go and you can message when you do go on to launch your fundraise. That can be really distracting. That can take up a lot of time during a time that a founder just wants to put their head down and focus on the business. So my suggestion is always go for a coffee, have a half an hour call with the fund, sell the vision, sell the dream, get them excited, and then let them know that you will get in touch with them when you go on to launch the fundraise. Because if you're not fundraising, there is no value in spending hours with a fund at a time where you're not raising, and at a time that you're 12 months out from your next raise. So have that call, put them on the warm investor list, send them updates on a monthly or quarterly basis to keep them excited and to keep them up to date with what's happening. And then by the time you do go out to fundraise, you have hopefully a list of investors that you've already engaged, that are already somewhat excited, that are up to date with what you're building. And you can just start your fundraise with that level of momentum. And instead of going out to the market cold, you've got 10, 15, 20, 25 funds that you can go to. And that really helps get the ball rolling as you're filling up the pipeline. And that's literally how I think of a fundraise, almost as a pipeline of other funds, and to really start getting those conversations going. So that's what I would recommend doing. What I instead see founders quite often do is, that approach almost falls in the middle of the two scenarios that you gave. And what I instead see is founders actually being quite binary about how they go about this approach. So either they'll talk to no investors, and then suddenly they'll go and decide to launch a fundraise, and they've not spoken to an investor in 18 months, or if they've bootstrapped, they've never spoken to an investor. And so they don't know what a good or acceptable round size for the metrics that they have and the point that they are in their company life cycle looks like, because they've not had those conversations with investors, or they've not practiced their storytelling, which is super important when you're going through a fundraise. That's one end of the scale. And then right on the other end of the scale is founders that spend hours and hours and hours in their week speaking to investors and getting pulled into conversations, and sometimes even getting pulled into a process with investors at a time that they don't want to be, and at a time where it's not the best use of their time, because they should be focusing on the product, or they should be focusing on customers or other opportunities. So as with everything else, these things aren't binary. So don't be binary, and find a good middle ground where you can take elements of both and make it work for you.
That's great advice. Great advice. I like it. When I look at your day, so reaching out to investors, I think it also helps understanding how the day of an investor looks like, how you split up your day. How does your usual day at Playfair Capital look like?
Good question. So I will caveat this initially by saying that we are a single LP fund. So we don't fundraise from external LPs. And straight away, that is what an investor normally at a fund would spend anything from 10 to 30 to 50% of their time doing, depending on where they are in the fund life cycle, either actively fundraising or closing out a fund or reporting to LPs. So we don't do any of that, which is great, and usually the source of envy from some of my friends in VC. So what do I spend my time doing? So I really roughly split my day into working on new investments, portfolio, and everything else. So the first bit, I'd say I probably spend about 70% of my time on new investments.
Mm-hmm.
So that is everything from sourcing, taking pitch meetings, doing deep dives into certain markets or industries or companies, writing memos, preparing for IC, doing ICs, creating term sheets, doing legals, going through negotiations, and that entire process really is the bulk of my day. And depending on where I am with a particular company, I'll be at different points of the process. So there are some weeks where I might have 30 first calls, and that 70% will solely be first calls, and it will solely be at the sourcing part. It'll be the very early part of that process. There are some weeks where I'm pushing an investment opportunity forward, and so most of that 70% is spent on writing a memo and doing diligence and preparing for IC. And I might still have a couple of first calls back in the sourcing or the first call part of the process, but most of my energy and most of my time and resources really being spent on getting obsessed with this one company. It can be quite difficult to shift between the two because the two have completely different mindsets. One requires you to be very open and very inquisitive and to learn. And the other requires a level of depth and diligence and attention to detail and focus. I quite like going in between the two, so I quite like doing both. But I always think it's what sometimes maybe founders don't always appreciate is you might be meeting an investor when they're about to take a company to IC tomorrow or the day after. And so an element of their brain space, an element of their energy is focusing naturally because you're somewhat emotionally invested at that point of the process in how's that IC going to go? How can I prepare for that IC? Am I missing anything? Is there anything I've not thought about? And it's just always worth having in the back of your mind that similar to a founder, where you have so many different things going on, even this investment process for an investor can mean that you're in completely different states, mentally or physically in every way. So that's 70% probably of my week. Mm-hmm. I'd say probably the remaining majority of like the 30% is portfolio. So I sit on 4 boards currently. At Playfair, we are a very high conviction, low volume fund. So we make 6 to 8 investments a year. And the reason for that is we like to preserve time, resource, capital to spend with our companies post-investment. So every investor at Playfair generally holds a maximum of 6 to 8 board seats at any time. And the reason for that is so that we can focus and we can dedicate ourselves as investors to our companies post-investment. So the 4 companies that I work with, I might spend time helping them with their fundraise or helping them with their financial model or preparing for board meetings or going to board meetings or helping them with hiring and taking some interviews for them. It can be really anything. And so a lot of that is very ad hoc. But generally, I'd probably say about 30% of my time spent on that. And then there's kind of everything else, which I've not really accounted for, but a lot of funds, early stage funds particularly, are probably made up of teams of 5 to 10 people. And so in a way that they're almost startups themselves, they're almost small companies themselves. So then there's everything else. There's the brand building and the network building, making sure that founders out there know that they can come to Playfair when they are raising funds and they know who we are. There are the network building bit, which is meeting investors who could be a good potential fit to follow on in some of our portfolio companies. There's all sorts of ad hoc stuff that takes time and energy. That is more about being an ecosystem player. Our female founder office hours events, for example, take a huge amount of time to organize. But we feel like that's really important to support female founders and to just be a really, really good ecosystem player, with the view that if you do good things and you make connections with people and you're a valuable player in the market, that good things come back to you. And it doesn't necessarily need to be transactional. Those things don't need to happen tomorrow. You know, you don't do to get, but actually you do because you want to, in the good faith that things will come back to you at some point. And I think that's quite a nice way to that's quite a nice way to be.
That's good to hear. That's good to hear. So I understand that the Playfair Capital approach is being more an, let's call it active investor, and help their founders moving forward, also creating connections to other funds. And it's less like a passive investor that just throws money into a company and waits a couple of years until something comes out. Did it get the right understanding?
Very much. Yeah, very much. And I don't every fund has their own way of doing things, right? And they have their own thesis. And you know, if you look at the power law of VC, actually it makes sense for early stage funds to be making lots of bets in considering just how risky early stage is, with a chance that 1 or 2 or 3 might go on to have a substantial exit. So I suppose our model is really adopting a later stage model, almost like a Series A style model, and applying it to the early stage. I suppose with the confidence and the belief that our diligence means that we're spending that little bit more time with founders and we're able to pick out the better opportunities. And then equally the post-investment time that we spend, we hope makes, even if it makes the slightest difference in optimizing that company's chance of building a successful business, we feel that's worthwhile. So yeah, I suppose our model very much goes against the kind of typical early stage way of investing. But also it's just a lot more fun. it's just right. It's just so much more fun. Like I absolutely love the work that I do with my portfolio companies. It's genuinely what energizes me. The founders that I work with, I'm so inspired by them, and I learn so much from them. And I hope they learn from me, but I learn so much from them. So I think I'd struggle to be at a fund where we're super hands off, because I think that's the part that, to some extent, I enjoy the most.
No, I think it's definitely helpful for the founders to have a sounding board, or to have a VC who really helps moving the company forward, and also is active on the market, building relations to follow-on investors, for example. It also takes a lot of burden off the founders, so they can then really focus on moving the company forward and having a trustworthy VC in their board. What I struggle with sometimes is the many job titles that are in the VC world. So grew up basically in the 80s and 90s, and the hierarchy was pretty much flat. So you had the executive board, and then directors, and then everybody else. And when I look at funds, there are a lot of different job titles in that. Can we shine a bit of light on what the roles mean in your fund? Yeah.
So our fund, everyone does everything. So we like to see ourselves as having a very flat structure. So absolutely everyone sources, everyone takes first calls. Everyone pretty much does everything, which is great, and it's really good for learning, and it's a really good opportunity for everyone to experience every part of being an investor, to become a well-rounded investor, instead of just focusing on just one area. I'd say the biggest difference is the investors that have been in the team for longer, or have been investors longer, naturally will have more portfolio responsibilities. So Chris, our managing partner, I think has, I've forgotten off the top of my head, but probably 7 or 8 portfolio companies that he's actively working with, which is a lot. So he absolutely takes first calls, and he sources, and he's super involved in all of that. But he naturally will spend a little bit more time on that on the portfolio side, because of the companies that he works with. And then the flip might be for the team that are newest to the fund. So that's how it works at Playfair. I think it really depends fund by fund, and I always say to founders that it's important for you to understand what the fund structure is at the fund that you're talking to. So there are loads of funds that have a similar approach to Playfair, where everyone that you speak to is likely to have a voice at the table. That's great. That makes things nice and easy. There are other funds where you might be speaking to, and it's typically more junior members of the team, mm-hmm. and they're super excited and they're really passionate and they're championing the company internally. But ultimately, they're not part of the IC. They don't have that decision-making power. So their enthusiasm is not necessarily an accurate representation of the enthusiasm of the IC, who are the ones that will decide whether that fund invests in your company or not. Mm-hmm. And so that can sometimes be quite misleading, because I'll have founders who say, I've been talking to so-and-so for weeks and they're really excited. And my first question will always be, well, how does it work? Who has the decision-making abilities at the fund, and how does the IC process work? Because that will give us a good idea of how the fund feels, and whether what that investor feels and whether what the fund feel are aligned or whether they're not. Having said that, I think sometimes founders can also go the opposite way and underestimate the influence of junior team members as well at mm-hmm. funds where there is a hierarchy and structure. Junior team members have typically more time and they have more energy and will spend longer trying to understand the thesis of your business, and they might have more time to dig into the market size and do research on the competitive landscape, and ultimately time to just get to that point where they are excited about your business in a way that perhaps the partner that you're trying to get in front of might not have that time. And so having that opportunity to impress someone, and someone being open and receptive to it, who then goes into the company internally and gets everyone else excited about it, that's great, right? That's someone saying that I'm going to champion you. I'm going to sell you to my IC and to my fund. That's really valuable as well.
Yeah, I think this is absolutely an important point that you mentioned, to find a partner or a team member in a venture fund who is really excited about the opportunity. Basically, it's selling. It's a selling job, and exactly. It's not something that you just throw the pitch deck on the table and say, okay, now pick it up and invest. So it's finding the person who really clicks with the idea. This is, I think, really exactly. a key point that's often missed. And when I read through books, I think I rarely see that in a book in a description to just look how people react to your opportunity.
100%. At the end of the day, this is a people business. We're humans. And the investor that you're talking to is a person, and you want to get them personally excited about what you're building so that they then can get excited or see an opportunity to invest in the company. That's step one. That's emotional engagement. That's emotional excitement. And quite often I see some of the best founders, at least the founders that are really good at fundraising, have extremely high EQ. They're people who can pick up on cues, and they pick up what people are motivated by, what people are excited by, and they're able to tap into that and say, okay, well, let me tell you more of this. Or they're able to look at a team and they're able to say, well, that's the person who's covering this sector, or that's the person that's most interested in the space that I'm working in. So I'm going to go after them. And that's a really smart strategic way of doing it. Because instead of going to someone who despises health tech, you want to go find someone who lives for health tech. And it's not hard to do that. If you go on someone's LinkedIn, or if you go on the team page on their website, it will probably say whether they're interested in health tech or not. So I think doing that little bit of work and doing that bit of research and homework, as well as really tapping into the emotional cues of how people are engaging with you, just gives you such a good read on the right person that you should be speaking to and the right person that you should be pushing in order to get that meeting or get that follow-up meeting. And yeah, sometimes maybe founders forget that
These are basically two important learnings here. So one is getting to know the people, getting to know, understanding also their emotional cues. What are they interested in? What drives them? What motivates them? And I think the second important part is doing the due diligence on a fund as well. So finding out what is the area of interest of the fund? How is the fund set up? Does the fund have money? Instead of wasting time and just going through a list of 100 VCs and pushing a standard email on somebody's table. Jeevan, I think your earphones, your mic is off. So
sorry, I was on mute.
Yeah, now you're back.
Yeah, but hear me now. Yeah, I think I understand that it can be quite difficult to do some of that research. So VC is typically an opaque industry. If you go on the website of most funds, they are not going to tell you if they are actively fundraising or not right now. They're not going to tell you if they're in between funds. And the first close is happening in Q1 next year. And there's many reasons for that. But they're not, getting that information is pretty tough. You can only work with what you have, but through social media and through VCs becoming more and more content driven, you actually do have a good amount to work with, or at least a lot more than founders 20 years would have had to work with. You do know what investments a particular investor has made before. You can figure out what type of sectors and industries and spaces they're really interested in. And VC investors are increasingly building more of a personal brand outside of the fund brand, again, through social media. So suddenly a fund doesn't necessarily mean the individual. There might be an individual within that fund who's super passionate about what you're building. And you ideally want to go find that person. You want to find the best person possible within that fund to be speaking to. And I think treating every single investor within a fund as an individual with different interest areas, different things that they get excited about, different areas of passion, instead of just seeing them as a fund, can optimize your chance of getting in front of the right person. And if you can optimize that, you can optimize the chance of getting them excited, which can then optimize the chance of you getting funding. And these are the little things that really make a difference in the long term.
Yeah, absolutely agree. And I like the role social media plays these days. When I think back in the 90s, it was really difficult to look inside a company and get an understanding of what drives and motivates people inside. Now we have, for example, LinkedIn, and LinkedIn is a great tool when people post content to get a better understanding about the right fit. Do we have the same beliefs? Do we share the same ideas? Do we have the same vision? And it's much better. How do you see the role of social media these days in investing?
I think it's massive. I spend a stupid amount of time on LinkedIn. It's so bad. I use LinkedIn on like a Friday evening and the weekend. I'm on it all the time. It's replaced Instagram for me. I think that LinkedIn has it's just made the world in a way a lot bigger, but at the time a lot smaller. It's made people, it's made investors in Silicon Valley accessible to some extent. It gives you a platform, a scalable platform to share your views with thousands of founders at once in a way that you would never have the opportunity or the time or the resource to do on a one-on-one level. So the communication, the accessibility, the relationship building, the information sharing, all of that is super powerful in an industry that's all geared around making connections.
Yeah, that's true. Let me ask you, sorry to interrupt you, let me ask you one question, another question to the role of social media. You also mentioned that you have a podcast. It's called When Unicorns Fly. What's your opinion on podcasting in this industry? Does it make sense to come on podcasts to speak to people and post content in video content on the internet, or is it not so necessary? Does it make a difference?
I mean, I'm here today. So I'm already a believer. Yeah, I mean, I had my own podcast for a year and a half called When Unicorns Fly, and the purpose was to bring valuable content to early stage founders from subject matter experts across marketing or PR or legals or different functional industries. I absolutely love podcasts. I think it's a really easy way of being able to share content and again get access to people that you wouldn't otherwise have access to. Super scalable, high impact for the people that are engaged at least. I think podcast listeners, real podcast listeners, are some can be really dedicated, and if you can build that following, you can build a really good audience of people who are interested in receiving that content. But I also just think if you're trying to reach people who are already really busy, time strapped, cash strapped, free podcast episodes for half an hour, 45 minutes, an hour, it's a really easy way for people to just slot that into their lives, or it's a lot easier than the commitment of picking up a 500-page book and deciding to try and get through that. So yeah, I think the distribution, the accessibility, the scalability of podcasts is really cool. And just on a personal level, I listen to a lot of podcasts myself.
Which one do you listen to?
Which ones? I'm a massive fan of Tim Ferriss. So I think the guests that he gets on are great. He does a lot of research before he does the episodes and goes in really, really deep. And I think some podcasts can be slightly superficial in the type of kind of the level that they remain at. So I think I love just how deep he goes. I always say my guilty pleasure is The Diary of a CEO, which is run by Stephen Bartlett, a UK based entrepreneur and investor. I just think again that the caliber of guests that he gets on, I just think are great. So I particularly love all the founder episodes, and he's had some really cool people on there. And then yeah, I really enjoy some of the non-VC related ones as well, or the non-entrepreneurial ones. So some of the podcast series, the 9-episode series, whether it's journalism or true crime, which is a personal favorite of mine, or just understanding different industries. So my partner's really into music. He's an absolute music head. So, I love just hearing about what's happening in other industries as well. And I think, again, podcast is a really low barrier to entry almost. You just go on Spotify, you subscribe. That commitment isn't really needed in the same way. So big fan of podcasts personally.
Yeah, I couldn't agree more, man. That's why I have a podcast, I guess. What I like in podcasting these days is like having a conversation with you, for example. A couple of years ago, it was basically impossible to meet virtually. So I think 10 or 15 years ago, because the technology didn't simply exist. And finding out the belief set of another person was really hard work. And to see, is it really a great fit? Does it make sense to put people together in a team? Because basically VCs and founders are a team for several years. It's like a marriage, basically. And today, when you get on a podcast, we can have 1.5 hour conversation. I can share it on the internet. And everybody who is interested in Playfair Capital and thinks maybe you might be the best investor for a company can just click into the episode, get a feeling for you, get a better understanding of what motivates you, and then can decide, does it make sense to reach out, or are we completely on two different planets?
100%. I always say that founder investor or founder fund fit is so important. And I can understand that when you're trying to raise for your company and your runway might be 6 months, 9 months, you're probably thinking, God, why would I care about founder investor fit? I need cash. And smart capital is great, but it is what it is. And how useful are VCs anyway? But in reality, this is going to be someone who's with you on that journey. They might join your board, which is where all of the strategic levels on that company should really happen. They're going to have a massive impact on the direction of your business. If they're a good investor, you're going to want their direction. You're going to want their advice and their support. So absolutely taking the time to do your due diligence on the investor as well, and understanding whether their values are aligned with your values, and whether you see that 5, 10, 15-year partnership happening, and whether that enthuses you or actually fills you with dread, tells you a lot about whether you actually want to work with them, right? And I always encourage founders to do that.
No, it's also, I agree to what you say. It's also my recommendation when founders are young as an entrepreneur, not necessarily in age, select a fund. It's just, as I always say, you will work with that fund probably for the rest of your life. So the connections that you create now, you will also have in 10 years. So really choose wisely and not just because of capital. And having said that, my next question to you is the expectations and managing the expectations between funds and founders. What do you expect from your founders? Is it just that you want to throw your capital in and say, okay, that's it, come back in 5 years and bring me 10x back? What are your expectations to founders?
That's a really big question.
Open question.
Open question. I think, so I'd split it almost into two ways. One is outcomes and outputs, and the other is working styles and how you work together. So outputs and outcomes, of course, I wouldn't have invested in that company if I didn't see a VC scale exit or return at some point in the future. Mm-hmm. So that is what I go in hoping for. It's not necessarily what I go in expecting, because I'm realistic and I appreciate that I sit in early stage VC, which is high risk, and predicting what's going to happen in 10 years time would make me a reader of the future. So which I'm definitely not. So anything can happen. And so when it comes to the outcomes and the outputs, really it's a journey with many processes, with many milestones. Let's break it down, whether we want to break it down in terms of what the product roadmap and the product development is going to be to get to that end vision of where the product should be, or whether it's looking at our commercial success as a proxy of our growth, whether that's revenue or engagement or customers or users, or whether that's fundraising. And each fundraise round is almost a milestone, and we say we're going to break the journey down in that way. However that happens, as long as we trust in the process, and as long as we're building a good process, and we have the right milestones, and we're tracking whether we're on track, and we're doing something if we're not on track, the outcome will take care of itself. And at the end of the day, all we can do is try. There are so many things that are outside of the hands of the founder, and a little bit of luck is needed as well. But as long as you create that framework and you follow that framework, and you flag if you're struggling, and you get help when you need help, and you get support when you need support, that will almost take care of itself. So my expectation is definitely not that every single company I work with will become a £1 billion company. That's unrealistic, and would mean that Playfair has the best portfolio in the history of venture capital globally, which would be great. But
I think you have it.
So yeah, that's one part. And then the other part is, how do you work together with the founder as a fund, as an investor? And on that side, again, I'm really open to how the founder wants to work with us. So we have second time, third time founders in our portfolio who have been there, done it. They've made all the mistakes. They want capital. They want our help. They know what they want our help on, but otherwise they very much just want to crack on, do their thing, get moving. Absolutely fine. We're not going to get in the way. We're not going to slow you down. We're not going to stop you. We're not going to make you take help if you don't need it, or if it's going to get in the way. That's fine. But equally for the founders that are maybe first time founders, or do want more help and do want their investors to be more hands-on, and have the ethos of, why would you turn down free help? We want to be there for them, and we want to have time, resource dedicated to be there for them. And so for them, I always just ask at the outset, how do you want us to work together, right? Like this is a working relationship. How active do you want us to be? Where do you want support? What are the areas that you want support? And having that conversation at the outset sets the expectations from their side and our side on what they want from us, and what we want from them. And I'll put my hands up and say that I've not always done that. There have been times where I've worked with founders and I've not had that conversation at the outset, and it only delays the inevitable conversation, which is, let's sit down and align and set expectations and decide how we're going to work together. So nowadays I try to do it at the outset, right at the very beginning, and just set the solid foundations and start things as you mean to go on in the strongest way possible.
Now, that's a very clever move to manage the expectations before people start to work rather than in between. I think it clarifies a lot of problems early on that later on, as you said, naturally appear. I met founders who said they would like to have a hands-on VC, so that the VC gets really involved into the business, which I think is probably more on the business angel side, my personal opinion. The bigger the funds become, the bigger the portfolio becomes. I think it's naturally that also a venture fund is a company by itself, so it needs also internal management. And I'm more from the side of the same. I mean, I like to have a VC as a board member, as a moral compass. When I just look at what's happening now in the world with FTX, for example, where when I go through the news, where I very often see that there was absolutely no oversight. So when I read through the headlines, I would say having a VC on board who makes aware of where the fine line sometimes is, that's in a startup that's really creative and building something new, it's sometimes really difficult to figure that out. Absolutely makes sense. When I think about the
I don't think, I was going to say, I don't think there was a fine line with FTX. I think they saw the line and just decided to.
Yeah, this is something for the courts to decide. So I'm not I'm not in the legal, but there's probably fraud involved. So heavy
yeah,
fraud.
Absolutely. But I think to your point, 100%. And being a VC doesn't, having a good relationship doesn't necessarily mean that every conversation that you have is going to be an easy conversation. It's not always patting someone on the back and saying, great job. I mean, you hope it is, but that's not reality. The reality is that you want an independent person, objective person who challenges you in a healthy way, gives you another opinion, challenges at the right time, and steps back at the right time, and gives you that advice when you need it or where you ask from it, but isn't a yes person, isn't someone who's afraid to voice their opinion to you. And that's the type of person that you're looking for, and that's quite difficult. That takes years for people to build that right balance of getting all of those attributes. And I think the easy route is sometimes to find someone who says, I'm hands off, I'm not going to join your board, I won't be that present. And that's great, that might be what you're looking for. But healthy challenge and a sounding board, someone who's engaged and wants to be there and is easy to get hold of, is the exact opposite of someone who's just, I'm passive, I'm off.
No, when I'm in a board role, I think what I need less is having a friend in a board meeting. I would rather have someone, let's say a sparring partner, who's giving me the punches in a board meeting, rather than letting me run into an open knife. So when people see that, so I think this, what you mentioned, is getting challenged by the investors is really a great thing.
Absolutely. And we can be friends when we go for a pint after the board meeting, and we can catch up on life and everything else. But in that time, it's not personal. It's, you want someone who, as you said, gives that healthy challenge and becomes that sparring partner, but in a positive way, in a way that you're all growing. And as a sum of your parts, you're stronger and you're better, rather than working as individuals.
But sometimes to also have someone who's pointing in the right direction, who say, okay, this is your North Star, because there's a lot of noise in companies, employees, customers, suppliers, everything is coming together, the company is growing, and it's really easy to get sucked into the daily business and just forget about the mission. And having the board meeting who really brings the team back and say, look, guys, this is your mission, focus on your mission, move the company forward, is great help. When we talk about
Absolutely.
the relationship between founders and investors, you mentioned it's not always a happy family. How is the reality? Is the interest between founders and investors always aligned, or are there also some critical parts where you would say, okay, sometimes it's pulling into two different directions?
I mean, as an early stage investor, I'd say that generally I can't think of many situations where you wouldn't want to be aligned with the founder. I mean, there are definitely times where you could be, but many times where you wouldn't be. If the board is functioning as it should be, you're making decisions collectively about the future direction of the company, and you should be supportive of those decisions that the founder is executing on, because those are the decisions that you've made collectively as a board. In reality, can be slightly different to that. So in reality, VCs might want to be more revenue or commercial or metrics focused, and founders typically tend to be more product focused. I mean, that's one stereotypical example, but that can happen quite often. And again, that works well in a mixed board where you have different voices, where the founder is saying, well, these are the milestones, this is what we need to achieve to build a product that our customers are willing to pay for. But the VCs are saying, okay, great, you can build the best product in the world, but how do you prove product market fit if ultimately no one is willing to pay for it? And having both works really well together. I wouldn't say that's misalignment, though. Again, I'd say that's just healthy, maybe differences of opinion. I think really the only misalignment that I can think of that can arise is at the subsequent round, when founders want to go and do another big round and preserve their dilution, and do it at the best valuation possible. And the fund might want to follow on into the round. And if they're putting more capital in the business, they're almost in this strange space between not wanting to get diluted on their existing shareholding, but perhaps also wanting to increase their ownership. And so they want that capital that they're putting into the company to be optimized at, of course, the lowest price per share, which means a lower valuation. That where the VC sits will generally depend on whether they're just protecting their current stake or whether they're actively trying to increase their stake. Perhaps you might see more misalignment in what you want if the VC is looking to actively increase their position. But that's really the only time that I can think of that there might just be a difference in what the VC might optimally want and what the founder optimally wants. But again, if the founder and the investor are both working for the long term and they're looking to build a big business together, the way we always put it at Playfair is, this is a pie, and we'd all much rather have a maybe slightly smaller slice of a bigger pie than have a massive slice of the small pie.
Yeah.
So if we're all thinking about growth and we're all thinking about scaling and we're all thinking about what this thing could become, hopefully those misalignments don't get in the way of us building this massive business for the short term.
I couldn't agree more. I always like the example of Amazon. It's better to have 1% in Amazon than 100% of nothing. So it's basically a great point. You mentioned this product market fit. I was smiling because I think, especially in scientific companies, it's a lot of possibility to build the best product ever for no market, actually. How do you manage to hold your founders accountable to not fall too much in love with the product, but spend their passion more with finding out what the customer needs? How do you do that?
Yeah, with great difficulty normally. I always try to align commercial and product milestones. So if we're trying to get to X point with the product, what's the commercial rationale for spending time and resource on building that product, and what does that give us on the commercial side? So for example, we're trying to build a product for a pilot that we are lining up with a customer, and we need these two features because that is what will enable us to unlock that pilot. Fine, because the commercial rationale in that instance is that you secure the pilot, and hopefully you secure funds off the back of that pilot, and you're able to evidence that there is a customer that is willing to pay for that pilot. And so in that case, it's really easy because the product build is a direct requirement to unlock that commercial milestone. I suppose where it gets really difficult is where you're building and it's not quite clear for what or to what commercially you are building. And that's a scenario that sometimes as a VC, you might have to step in and say, in an ideal world, we would build the best product we possibly could today, but with limited time, with limited resource, with limited money, what is the bare minimum? Because that is what an MVP is. What is the bare minimum that we can do to service customers and be able to start showing product market fit? And in my view, product market fit, and we use proxy as a product market, we use revenue as a proxy of product market fit to say, well, if customers are willing to pay for this product, you're evidencing that there is a need. We don't know the scale of the need, but there is a need. And therefore, there is space in this market. Again, we don't know the size for this product. So that makes sense. But to build a product in a black hole, in a vacuum, without being able to evidence that there is a need from customers is tough to continue back supporting, particularly if the company's resources are disproportionately being spent on product build and product resource. I suppose there are exceptions to that. So there are companies that have totally rejected that advice from VCs previously and said, actually, product-led growth is the way that our company, that is what's going to work for our company. And that works. It's a super tough model because it's difficult to fundraise off the back of very little to no commercial traction. But it's been shown to work before. So I think in that case, as a VC, it's, well, this is my recommendation. This is what I've seen. This is what I suggest. But ultimately, the founder knows what's best for their business. The founder knows that they're at the helm. They're the captain of the ship. And ultimately, it's their decision on which approach they want to take.
Yeah, Steve Jobs was a genius in product market fit. I think he had the talent of understanding people's needs before they even knew it. Before they really, iPhone, who needs an iPhone in a saturated market? And he successfully demonstrated that you can place a product in a saturated market when you know what customers need and what they're looking for. I think it's the most important thing, 100%. Finding the MVP. Let's talk about a deal. What was the deal that you were most excited about?
I'd say probably the first investment that I made when I joined Playfair. There's always something special about the first one. So it's a company called Material Evolution. They're one of our portfolio companies. It is a materials manufacturing and machine learning technology company. They are building novel materials that are sustainable, that are better in many ways than materials already available on the market. And they just have a massive vision. They have just such an exciting thesis, which is they're starting with cement. Their thesis is that cement accounts for 8% of global CO2 emissions. It's dirty, it's bad for the ecosystem, it's bad for biodiversity, it's bad for water. There's so many negative implications of manufacturing this material. And yet it's something that we really need as a society because it's super scalable and it's a lot easier to transport. And a lot of the buildings over the past 50, 60 years have actually moved to using cement as a core part of their building product. So these guys want to tackle a massive market with a massive problem, using technology that actually has the ability to fundamentally revolutionize that market. And to me, that's really exciting. It's not a step change. It's not a nice to have. It's making a fundamental impact in the world and to real people, and that's super exciting to me.
Did I hear that right? You said cement. The company is about cement, and cement is responsible for 2/3 of CO2 emissions.
Of 8% of CO2.
8%. So it's not 66%, it's 8%. It's really
8%.
Okay, that was a misunderstanding from my end. Sorry for that. How did you find the company?
So this was a company that Chris, a contact, a friend of Chris at the Heritage Group, emailed over to him and said, I think this is something that might be quite interesting for you to look at. And that was evidence of a time where people knowing what you're interested in as a fund, what you're interested in personally as an investor works really well, because they're able to recommend something that they'd already invested in the company, and they were following on in the following investment, were able to say, well, this is something that we believe in. This might be something that's interesting to you. That's how we came across them. I think we might have first come across them. The timing is a bit unclear in my head. Liz took part in our Female Founder Office Hours event and met one of my other team members called Simon. So I'm not quite sure which one came first, but actually it's quite interesting to show how quite often there can be multiple routes to meeting a fund and multiple ways to get in front of a fund. So yeah, that was pretty cool.
Yeah, I think it's hard work for founders to get the pitch deck on the table first, and it must not necessarily be just one meeting. It can be many touch points, like in a sales process. Let's look on the other side of the table. What are the hurdles that VCs usually have to overcome when they want to get in a deal like your first deal? Is it just a clear flow? There are no hurdles, or are there also typical points where you say it's not that easy to get the deal nailed down?
I mean, there can be a bunch of hurdles, right? So the first thing is actually getting to the IC and deciding that you want to make the offer to invest. Parking that's just the investment process more generally. Hurdles might be you are not able to agree on terms, for example. So the founder and the VC disagree fundamentally on what they believe the valuation of the company should be and how much dilution the founder is willing to take for that fundraise. There might be disagreements in some of the other terms. It might be just a timing thing. It might be that the VC gives a term sheet and the founder isn't 100% sure whether this is the fund for them, and they want to wait until they're able to get to the end of the process with some of the other funds that they're speaking to. And as a VC, it's then it can be a little bit tricky because the founder is in a difficult position. I mean, other hurdles, you still have due diligence, legal due diligence, commercial due diligence to go through, and hopefully it's never an issue. But there could be something that comes up in due diligence at the last stage of the process. That means that the fund is no longer able to invest. I mean, that's never happened at Playfair, thankfully. But that would be a massive hurdle in actually being able to close out the fundraise. So I always say that nothing's done until the shareholder agreement and the long forms are signed and they're done. I try not to celebrate too early. But generally, if the VC is honest and transparent and the founder is honest and transparent, and you're in it for the right reasons, and you see a path to working with each other, and you feel that this is the right fit, there really, in theory, shouldn't be any hurdles. The practical execution of that can be a little bit different sometimes.
I like the two words that you mentioned, honest and transparency. I think this is very important in business.
100%. Yeah, super important, and really important for us at Playfair as well.
Yeah, that's true. That's true. Couldn't agree more. Let's move to the fun part of the conversation. One of my favorite podcasts is the All In podcast. It's for investors from the United States. They usually every week talk about what's going on in the world. And one of their investors is really good in predicting the future. And since we are at the end of the year, I would like to hear your predictions for the VC world of 2023. How do you see the world evolve for venture capital in the next year? It's just guesswork. It must not be accurate. It's just correct. It's just fun.
Got to make sure you don't hold me to this. I think obviously we are going into a recession in the UK, and a lot of the world is going into a downturn. So I suppose the doom and gloom of it will be, I think that people will be slightly more cautious of deciding to become a founder. So we might see less companies being founded at the early stage. We might see the volume of new companies go down. We might see VCs becoming a lot more cautious, and their risk appetite being far less than it was in 2021 and 22 in investing in new companies or even following on in their existing companies. And we might also see VCs actually struggling to fundraise from their LPs, because a lot of LPs are corporates or governments. And of course, there's that knock-on effect. If those bodies are struggling with liquidity, or they suddenly don't want to be overexposed to a high-risk asset class like venture capital, that trickle-on effect means that VCs are going to struggle to raise funds in a way that they might not have struggled over the past couple of years. So that's all the doom and gloom. Having said that, there's a huge amount of dry capital in the market. VCs have raised this year. Startups are still raising, and particularly at the early stage, we're still seeing a lot of activity happening. We're still investing. A lot of other funds that I speak to, most other funds that I speak to, are still investing. So as always, there's money out there for the companies that are in it for the right reasons, that are good, strong investment opportunities. And those companies are going to face less competition for talent with tech layoffs and less companies being around. They're going to face less competition from new entrants. They're going to face less competition for capital from other startups. So I suppose if you're if you're building a good product with a real market need in a massive opportunity to revolutionize the space that you're working in, I'm really optimistic that there's space for you to fundraise, and there's every opportunity for you to fundraise. And as a VC, I'm really optimistic that we are going to invest in a lot of companies that are exactly that. Maybe a little bit less than we would have in the previous years. Maybe we're going to see a little bit less volume, but we're still absolutely going to be doing it. So yeah, I'm cautiously optimistic, but very optimistic nonetheless.
Yeah, I couldn't agree more. There's always opportunity on the market, and I think the best companies started during recessions and downturns. Microsoft, Apple in the 70s, and I think WhatsApp, Uber in 2008, something around that.
Yeah, that's right. Yeah, exactly.
Jeevan, I have two questions left, but let me ask you another question first. Did we miss anything in the podcast that you would like to talk about?
Nothing. I think that's everything. I think you were very thorough. Some really good questions there.
Thank you very much. It's fun talking to you. So then let me ask you the two final questions. One is also predicting, which up-and-coming investor and fund are you personally excited about?
Oh, that's a good question. Which fund? I mean, I would say Playfair, but I feel like that's cheating, right? A small plug is that we are launching our next fund next year. So
really,
that is happening. So that's really exciting. Excluding us though, which fund am I excited about? I think it's difficult to pick any one individual fund. I think There's some really strong portfolios out there. So I think 2150, for example, they're based in urban construction, mobility, living. I think they have a really cool portfolio. I think they're investing in some really interesting things right now. I think, yeah, that's a tough one. I think there's a lot of super interesting funds doing really cool things out there.
What are the top 3 funds that you think about when you say there are many? So what is the first ones that come to your mind?
The first 3. So I'll definitely say, let's see. I mean, a lot of the top tier Series A funds that you would naturally think of. So I think Boulderton, for example, I think they have a really great team. They're really hands-on with their founders. They have a portfolio management team that work with their founders post-investment. So I think they're super cool. IQ Capital is a deep tech fund based out in Cambridge, and we've co-invested with them. And again, I think that they have a really quite a similar approach to us and just how hands-on they are with founders post-investment. And they also bring this really different angle from being super focused on deep tech investments. So that's also pretty cool. And then I think there are also interesting kind of, like venture debt players as well that are coming up. So Claret Capital, for example, is one that are just really offering founders an interesting alternative to equity funding and encouraging them to think about debt as almost like a top up to their equity round, but also as an alternative to just doing around a fundraise that is just 100% solely equity. So I think how they're working with founders and some of the content that they create is also pretty cool.
Yeah, it's great to hear that. What I like in 2022 is that the founder and venture capital ecosystem has really grown since the 90s. There is so much opportunity on the market, so many players on the market. And 30 years ago, it was completely different. It was difficult to get in touch with VCs. Most VCs were only in Silicon Valley, basically inaccessible to the rest of the world due to the lack of internet technology. And now we have LinkedIn, we have social media. We can have a conversation. You are in the United Kingdom. I'm in Austria. We can share your stories. It's such a great time. People should be more optimistic and looking in a bright future.
Yeah, 100%. I mean, when Playfair was launched in 2013 by a founder, Fede, we were one of very few early stage funds in the London ecosystem. And now, God, I could count 20, 30, 40, which is great. Right. And that's pretty cool.
Yeah, I couldn't agree more. Let me ask you the final question. What piece of advice helped you the most in your journey as an investor?
It's actually something that my dad would always say to me when I was young. And so I apply it to everything in life, but I think it's particularly helpful in VC. So the saying that he always uses is, it's nice to be important, but it's important to be nice. And I think that's really applicable to VC because there is this really strange, in a way, power dynamic between investors and founders. As an investor, you're a gatekeeper to capital, and it's your responsibility to responsibly allocate that capital. And founders come to you wanting something that you can give them that will enable them to survive and thrive. And it's really important that, even though you're in this position of relative power and importance, that you use that responsibly and you don't allow that to change how you treat people and how you engage with people, and every interaction you have with respect, and you're out to make friends and not enemies, and just generally that you don't lose your sense of self. So yeah, I think that's always been really important to me, but I think it's even more important to me in VC, where I feel like that the risk of that happening is slightly higher because of the position that you're in. So yeah, I always just try to remind myself that with every interaction I have.
No, that is great advice. Being kind, staying kind, having respectful approach to people is a really important advice. Couldn't agree
exactly.
more. Jeevan, it was great talking to you. I enjoyed the last 1.5 hours. I wish you and your family and the team at Playfair Capital happy holidays and a fantastic start into the next year. And I hope we can catch up someday in London.
Yeah, absolutely. And thank you so much for inviting me. I didn't even realize it's been an hour and a half. It's been a great conversation. Thank you.
Thank you very much. Great to have you on the show. Enjoy your weekend. Bye.
Yes, you too. Bye.